Hey, welcome back to Business 163, Personal Finance. Here we are now in video number 2 in our module on investing. And in this particular module, we are looking at what? We're looking at the big three principles upon which all of investing really rests. And so you can see here from the title slide what we're calling the big three principles. What are our big three principles upon which we build this entire concept of investing? Well, you can see here, the three big principles are compound growth, also sometimes called the time value of money. In addition, the second principle is risk, and the third principle is diversification. Those are the big three, and we're going to give you an overview of these things and give you at least an introduction to each of these very broad concepts that really make the entire investment world work and have, well, quite frankly, for generations, for many generations, we've realized that these very, very important principles of investment make growth work. So, first of all, let's talk about the difference between simple interest and compound interest. There is a way of putting your money into a savings account. You might find a bank that is paying 5% simple interest. What does simple interest mean? Well, I've given you the illustration in these first 3 bullet points. If you were to invest $1,000 in a savings account that pays 5% simple interest, at the end of year 1, you would earn $50 in interest. And so you tack that on, and now you've got how much in your account? $1,050. And then at the end of year 2, you earn 5% on your original investment of $1,000, which means you earn another $50, which means you total it up at the end of year 2, you now have $1,100. Now, compare that with the concept of compound interest. If you take $1,000, put it in a savings account, in a type of account that pays 5% compounded interest, well, at the end of year 1, you still end up with 5% of $1,000. You still earn $50 in interest, which means you end the year with $1,050 in your savings account. But at the end of year 2, the word compound interest means that bank is going to pay you 5% not only on the $1,000 you originally invested, but on the interest you earned the previous year. You're now earning interest, or 5%, on $1,050, not $1,000, which means at the end of year 2, you've earned $3 more in interest. You earned $53 at the end of year 2, and now you have a balance of $1,103. And you may be saying, what on earth is the big deal about this? Why are you making such a big deal about this, Tim? $3? That doesn't even buy me a latte at Starbucks. What is the big deal? Well, when we look at it just in the horizon of 2 years, maybe it doesn't look like such a big deal. But if you look at it over the horizon of 40 years, it makes an enormous difference. That's what this graphic here is trying to show you. The graphic, if you look carefully, what this is basically saying is, let's assume that you're going to retire at the age of 65, and you're 20 years old right now. And so with an average interest rate of 8%, let's say you start investing $200 per month starting at age 20. Well, you can see here what this is saying. The principle of compound growth means that measly $200 per month is going to make you a millionaire by the time you retire. That's right. Take a look at that, right? You will have earned over $1 million if you started at the age of 20. However, look what happens if you just start 5 years later. If you start 5 years later, that $1 million return shrinks to under $750,000. And then if you wait to start until you're 30 years of age, or 35 or 40, you see the point here, right here, the amazing power of compound growth. In fact, compound growth has been referred to as the 8th wonder of the world. That's how important it is, the power of time and compound interest in exponentially increasing the growth rate of any amount that's invested. That really is the engine which makes all of long-term investing work. That's why we make such a big deal about it as a vehicle for long-term goals and plans like retirement or buying a home or all the other things that you may have as stated goals for your investments. All right? The power of compound growth. In fact, if you end up going to a 4-year university to be a finance major, you will spend a great deal of time studying the nuances of what we call the time value of money and all of the implications of the time value of money. However, for us in this particular module on investing, what you need to know is the overall principle suggests your money can grow exponentially if you take advantage of compound growth. So start investing as young as possible. All righty, let's go on. That was the first principle, compound growth. What is the second principle? The second principle of investing is risk. Let's see if we can describe it this way. If you put your money in a savings account at any of the major banks, whether that's Wells Fargo, Bank of America, Chase Manhattan, wherever you end up depositing your money, it's probably going to be insured by the FDIC. The FDIC is an arm of the federal government that insures your deposit up to a certain dollar limit. And so if that bank was to struggle and eventually go belly up, you'd still get money back because your deposits are insured. There's a guarantee. However, second bullet point, if you put your money in investments, there is no insurance. The money you invest is at risk. And investing can be volatile, and there are no guarantees on your return. In fact, if you're not investing wisely, it's very possible you could lose your entire investment. However, having said that, I don't want to frighten you. Don't be scared. If you are going to embrace higher risk, all that means is that you demand a higher rate of return. The correlation between risk and return is another very large principle in the world of finance and investing. There is a way to invest in such a way that your investment money is very safe and very protected. It doesn't mean it's guaranteed, doesn't mean it's insured, it is at risk, but there are a whole world of investments out there that are, quite frankly, relatively safe. And there are other investments which embrace a higher degree of risk, some of which are so risky we actually describe them as speculative investments, where it is quite easy to lose your entire investment capital, right? There's a whole spectrum of different options and possibilities out there. You just need to know what you are willing to embrace and willing to tolerate in terms of a level of risk. So the second slide, what is risk? You can see here, right? With the purple rectangles here over the years, you can see here that stocks in the darker purple, right, have returned anywhere from as high as 21.3% returns all the way down to negative 4.4%. That's right, negative 4%, which means your investments are actually losing value during that period of time because of a drop in the stock market. Now, compare that to the lighter purple rectangles, which represent the returns on bonds, which are much lower risk category of investments, but because lower risk, they historically offer very much lower returns than stock investments. Well, you can see there that even in the years where stock returns were negative, there were still positive returns on bonds, just very, very small. You can see the relative numbers there at 6%, 0.6%, 2.7%, 3.5%, right? Which means that if you're really not in the place to accept a high degree of volatility in your investments, boy, stocks can really take you for a bad turn. However, in the long run, over the entire long run of a long investment horizon, higher risk can mean significantly bigger returns for your investment portfolio. All right? So, you can see here that risk is not necessarily something to be altogether avoided. It just needs to be acknowledged, understood, and managed. You see here, in the long run, tolerating risk can yield big rewards, but as you can see here, there are periods where, well, if you were invested in, some sort of a fund that was indexed to the S&P 500, there's some years where you're really, well, what am I doing here? This is really hard. It seems like, should I stay here or should I get out of this investment, right? But then look at the overall trajectory of this curve over time, all the way from 1990 all the way up to 2018, right? There may have been times when you were tempted to get out, right, and save yourself. But if you had stuck in the market, you can see that it has rewarded a patience and a tolerance for risk. Well, knowing that you can run into periods of volatility, how do we reduce our risk? Well, that's the third big principle in this deck, and that is the principle of diversification. What is diversification? It's not putting all your eggs in one basket. If you put all your eggs in one basket, let's say you took your entire nest egg and invested it in one stock. Let's say you decided to buy stock in, Apple. And if Apple had a couple of bad years, you could significantly damage your retirement, your nest egg, right? Or, let's be honest, if you invested in a company like Enron, you might have lost your entire nest egg, right? Your entire retirement. So don't do that. If you possible, don't put all your eggs in one basket. What if you were able to invest rather just in one stock in two different stocks, right? And let's say you put those two different stocks in two entirely different industries. So a little bit in the banking industry, perhaps, another in high tech, right? Or maybe you spread that out into even more baskets. And so you embrace different industries. You had some in stocks, some in bonds, right? There's a lot of different ways to diversify, or, as we return to the slide, to spread your eggs across more than one basket. Different stocks, different types of investments, different sectors, different time frames. Diversification reduces your overall risk, because if one basket is struggling, chances are, if you've diversified wisely, the rest of your baskets aren't struggling so much. Now, let's be perfectly honest. Diversification has one downside, which is it may reduce your overall return. However, what would you rather do? Earn a windfall or place all of your nest egg at risk of completely being lost? For most of us, when we talk about investing, we would rather earn a slightly lower return and keep the bulk of our nest egg safe rather than putting it all up at a high degree of risk. Well, I hope this has been helpful. There's more on this in the text course, and more, of course, you can study and research about this, but the big three principles that make the investment engine work: the time value of money, or compound growth, so important it's sometimes called the eighth wonder of the world. Risk. All investments have some degree of risk. The question is, what's the amount of risk you're willing to embrace? And three, how do we protect our investment from too high levels of risk? By diversifying our investment portfolio across several different baskets, so that if one basket is struggling, chances are the rest of our investments are not. I hope that's helpful. Those are three very important principles as we consider the rest of the things we're going to talk about in this module. We'll see you in the next video.